Hello, in this lecture we will define allowance method. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of allowance method is procedure that A, estimates and matches bad debt expense with its sales for the period, and or B, reports accounts receivable at estimated realizable value. When we're thinking about the allowance method, we're thinking about the accounts receivable and the sales related to it. Accounts receivable being the balance sheet account, sales being the income statement account. We want to report to our readers that accounts receivable as correctly as possible, as well as sales and the related net income as accurately as possible. Two methods to write off the accounts receivable are allowance method, direct write-off method. We're talking about the allowance method, that being the generally accepted accounting principle preferred method. Let's see why. If we look at the accounts receivable, for example, here we have $1,146,300 asset. That's what people owe to us. If we're providing financial statements to a reader of the financial statements, they would want to know how much of that money we believe would be uncollectible. We would like to provide that information. However, it's not that easy to do because we don't know how much of that is not going to be receivable exactly. We don't know who is not going to pay us, but we can look at trends from the past, and depending on the industry, we can see and make an estimate. That's what the allowance method wants to do. So we're going to say, okay, let's make an estimate and see how much is not going to be collectible. We'll put it in a contra account rather than that accounts receivable account, so that we can say, hey, this is the receivable. Here's how much that we're estimating that will not be collectible. And if you net those out, you'll get the amount of net receivables. We also wanted to look at the income statement where we have revenue here. What we want to do is, if we had this $378,000 on account, sales on account, we don't want to have the bad debt taking place at a later time period, next year or next month, because then the bad debt expense is not matching to the revenue in which it helped to generate in accordance with the accrual principle of the matching principle. Therefore, the allowance method is also bringing that expense back into the time period in which it was related to the revenue that has been earned. A couple of ways we can calculate this. One way is to take the accounts receivable balance and try to estimate by how old those receivables are, whether or not we are likely to get that receivable in the form of payment. Another way is to take the receivables, the revenue account, and multiply that times a percentage that we believe based on past history that will not be collectible. If you look at the balance sheet method, then we would basically take this receivable number, breaking it out between, say, 30, 60, 90, over 90 days that are past due, look at past date and say, what's the percentage we think we will get from those receivables given the fact that they are already past due. We may come to a number here where we came to 50,437, that being what we think the allowance should be. If that's the case, then we have to look at what the allowance is and then make it that 50,437 by, in this case, recording the difference, which would be this 50,437 minus the 15,003, giving us this 35,137. That would be recorded. Here's the credit that's making this 15,003 go up to the 50,000. Here's the debit recording the expense side of it. In essence, what happens now we have our accounts receivable. We're telling our reader that's how much people owe us in terms of accounts receivable. Here's how much of that we believe will not be collected given past history, but that is just an estimate. Here's our revenue, and here's the related bad debt expense that we believe is matching to that revenue that we don't believe we might not collect based on past history. We don't know who's not going to collect it. That's going to happen in the future, but we're going to write it off now so that we match this expense to the related income in accordance with the accrual principle of matching.